Hello and welcome back to followers of the Kaspa journey. Today we're going to be getting into Kaspa Solves the Trilemma. So what? The trilemma is a phrase that gets thrown around quite a lot within the Kaspa community, but what does it actually mean to have solved the trilemma? And why it's not just a nice to have, why it is essential that the future money of humanity and the perfect form of money has all three of these properties: decentralization, security and scalability, and what the consequences of the absence of one of these properties will be. So before we get into it today, guys, don't forget to like and subscribe, and don't forget to check out the Patreon as well if you are interested in a private Discord community, as well as 12 unique indicators. So today we're going to be going back and looking at all the different forms of money that humans have used, and what the drawbacks or weaknesses of these forms of money were, and what were the real world consequences of the money having that specific weakness. And then we're going to be having a look at the future of money and blockchain, and analysing what the absence of any one of the trilemma properties will lead to, and what will the consequences be of having the absence of one of these properties. So what are the properties of a good money, and what do we want money to do? So money should be three things: a unit of account, a store of value, and a medium of exchange. And to break that down a little bit, there are basically 6 traits that will predict a good money or a bad money: uniformity, acceptability, and in this case we mean verifiable and also censorship resistant, aka the permissionless nature of a form of money; a limited supply, it should be durable, it should be portable, and it should be divisible. And each of the 3 things that we want money to do can be broken down into these 6 properties. So for example, for a unit of account, it needs to be uniform, it needs to be acceptable, and it needs to be divisible. For a store of value, it needs to be acceptable, it needs to have a limited supply, and it also needs to be durable. And then for a medium of exchange, it needs to be portable, and it needs to be divisible. Before we had money, we had barter, and barter is essentially just exchanging one product for another product without any intermediary. The problem with barter is that as an economy becomes more and more advanced, and there are more and more goods and services within that economy, there become many more ways that a trade can fail than a trade can succeed. So in this example, with just 8 products in this primitive economy, there are 28 unique trading pairs. And so trade will only be possible if you have the thing that the other person wants and they have the thing that you want. And it's more likely in that scenario that the trade will fail. It's very good that we don't have a barter economy, because in order for me to eat, I would have to find a hunter or a farmer that wanted me to talk to him about money and Kaspa all day. And they probably do exist, but it's not a very likely scenario. So basically, barter is an extremely high friction economy where trades will fail much more than they will succeed. One solution to this is to defer payment through time. And this is something called social credit, or also known as time banking. And this is basically where when you do something for someone else, a favour for someone else, for example, or you share something with them, then there is the social expectation that at some point they will repay you in one way or another. This again is okay for small primitive communities, but as a community grows in size and complexity, it becomes more and more difficult to manage this system. So one of the main problems is that it requires trust. When you do something for someone or give them something, you're trusting that they're going to make good on their word and pay you back. It also becomes very difficult to keep track of who owes people what. And this becomes more of a problem as more and more people enter the economy and more goods and services enter the economy. It is also fundamentally difficult to quantify value. For example, if someone shares a piece of meat with someone else, then how many bits of firewood, for example, do they have to give them in return? So social credit and time banking are used quite a lot in family and social situations. So for example, if you share lifts to work with a colleague, then generally you will keep track of who has done how many lifts, and there will be the expectation that these lifts are repaid in the future. But for a complex economy, it doesn't really work, and it is a relatively high friction form of trade. So expanding on this a little bit is to create credit, aka deferring payment through time. So in this case, instead of just having a sort of social expectation that you will pay someone back at some point, you have an actual formal contract of exact good and service that you have given that is expected to be paid back in the same form at a later date, and generally with some sort of interest added. So in this example, if a baker and a butcher want to trade, and the baker wants meat, but in this case the butcher already has bread, then the baker could make a bread credit and say, okay, you've got bread at the minute, but at some point in the future, it's likely you'll want bread, so I'll create this bread credit. and that basically is a promise to pay a certain quantity of bread in the future. However, there are a number of issues with this form of money. So one of the first one, counterparty risk. What if the baker goes out of business? You're kind of trusting that the baker is going to be able to make good on his promise in the future, but there is no guarantee of that. You also have supply risk. So, for example, there might be a drought or an abundance of wheat one year. In the case of a drought, there would be a lack of bread that year. So that would be extremely good for the butcher because his bread credit would go up in value. But in the case of an abundance, there would be an abundance of bread that year. So his bread credit would go down in value. And it still fundamentally requires trust that the baker will pay. So that brings us on to commodity money, where instead of deferring payment through time, you are swapping the good or service for a universal commodity that everyone accepts. And this is slightly different from barter due to the fact that all goods and services are tied and measured by one other good. And this good is generally the most liquid and most saleable asset. So 2 examples of commodity money that have been used in the past are wheat and cattle. And I've attempted to rank them in terms of those 6 characteristics of money that we want them to have. This was basically just based on my own opinion. There's nothing quantifiable in this. So if you do disagree, please do put it in the comments. But I thought it was a good way to show the drawbacks of some of these forms of money. So in terms of wheat, it was actually fairly divisible due to it being sort of small and relatively uniform. But basically, the 2 main problems with commodity money was A, durability, and B, limited supply, as well as it being not particularly portable. So the durability, it's not a good idea to store your wealth into something that's going to either die or decay or grow mouldy over time, because that means you're literally losing money to the slow process of entropy. And so that's in terms of durability, but then in terms of limited supply, both cattle and wheat are relatively easy to create more of. And especially if the price of cattle or wheat goes up by a lot, then people are actually incentivized to create more of these because they want to capitalize on that rise in prices. And so, therefore, if you hold your money in either wheat or cattle, then your money will essentially expire over time, over the course of a couple of years if it's wheat. And if it's cattle, then it will expire over the lifetime of a cow. And you would also be diluted by anyone who decides they want to start a farm and start growing wheat and raising cows. So you would be diluted extremely quickly. And so that's why commodity money, especially wheat and cattle, did not survive as forms of money. So that brings us on to basically the next higher form of money that was used after specifically commodities, which was shells. Shells were a step up from commodity money in a number of ways. They were more durable. A shell will last a much, much longer time. And if it's well looked after, shells can be as old as, say, 500, 600 years. So shell money is relatively durable as long as it doesn't get broken in some way. And it is also relatively portable because you can wear it on your person and it's relatively lightweight. However, again, the main problem with shell money is the potential to create a lot more of this form of money. And this especially became a bigger and bigger problem as human civilization and human technology increases and gets better, because that technology gives you the ability to more easily create more of this money. And so shell money might work okay in a relatively primitive society with a relatively low level of technology. But in a technologically advanced society, shells are extremely easy to create more of. And so it's a bad form of money. And that brings us on to gold and silver. Gold and silver are essentially what the entire world settled on as their forms of money, because they are the best money that nature can provide to humans, and they are the best ledger that nature can provide. So gold is durable. It has a very good limited supply with only around 2% inflation rate per year. And it is also uniform because it can be melted down and you can't differentiate one bit of gold from another. Now, silver has a lower score on the limited supply because silver has around a 3 to 4% inflation rate per year, which is quite high. But the advantage that silver had over gold was mainly around the divisibility. Because gold is too valuable per unit of weight, a worker would not be able to split that gold between all the goods and services that they needed in a week, whereas silver was able to be split between all of the goods and services. So despite it having a higher inflation rate and being worse on that limited supply and being a worse store of value, it was essentially a better medium of exchange. And so the gap in the market that gold left from being a poor or being a worse medium of exchange, but a good store of value, led to silver being accepted as a medium of exchange, even if it wasn't preferred as a store of value. Another major issue that both gold and silver had was the portability. And gold is slightly more portable than silver due to it having more economic density per unit of weight. However, it's still relatively low with a 3 score on the portability scale. And this issue with portability has led to essentially all of the problems we have in our financial system today. Because of the portability, there's an efficiency to be made by giving your gold to a trusted custodian and depositing your gold in a bank. And then instead of using the gold as the bearer asset, you leave the bearer asset in a trusted place and they issue a receipt or a claim on that gold, which is essentially paper money. And this paper money is much easier to handle and much easier to transport, and therefore much more portable than the actual base commodity of gold. But the problem with this is that because of human incentives and the fact that at any one time, most of the depositors of gold in a particular bank will not ask for their gold back, banks saw the opportunity to loan out on the faith that the majority of people would not ask for their gold back at any one time, and they would only ever need 10 to 20% of the actual gold to cover all customer deposits. And by doing that, they can then offer the service of depositing and keeping the money safe in the bank for free, because you no longer have to pay them in order to keep your gold safe, but instead they will actually pay you the interest that they earn on that money. And then because one bank does this and is able to lower its fees or even make banking free because of it, then every single other bank is incentivized to do this. And this leads essentially to a higher and higher number of claims on the same piece of collateral. So basically, more money in the system than actually exists in real life, aka credit or debt. And this can work for a while until trust and confidence is lost or there's some sort of credit event. And then everyone will try and make good on their claims at once. And the bank can't pay it because it doesn't have all of the collateral that has been deposited in the bank, because that collateral has been lent out and there are multiple claims on the same piece of collateral. And so because of this issue, especially with private banking, central banks were created. There's multiple reasons central banks were created, but one of the main ones was to essentially regulate and police private banks, and all private banks will deposit their collateral at the central bank. And so the central bank will kind of act as the main overarching bank of all of the banks. It is the bank of the banks. And the theory was that they could regulate the banks and regulate how much debt they were creating in the system, and then, in theory, reduce the amount and severity of bank runs. However, this gave central banks ultimate control over the money supply. And in 1971, President Nixon took us off the gold standard and essentially made all paper money completely unbacked and unpegged to anything. So it's now a completely free-floating currency. And this really is one of the main issues that our current monetary system faces. You know, with rampant growth of M2, the declining purchasing power of the dollar, and the divergence of productivity and real wages in the economy. And so it is because of the limitation of gold and the low portability of gold that we have all of these issues within our current system. And this was the problem that Bitcoin aimed to solve when it was released in 2009. And so we get to the trilemma, because Bitcoin obviously came out and it's fully decentralized and fully secure, but not scalable at all. And then all of these other projects have come along and they generally have compromised in some way on decentralization in order to increase scalability and security. So for example, BNB has a very low amount of validators, but it's very cheap and relatively fast to use. And so we have this diagram on the right, which shows that proof-of-work consensus mechanisms, at least historically, have done very well on the decentralization front, but generally are not particularly scalable. And if they are scalable, then they have to compromise on security in order to do that. And that's something like Litecoin. And proof-of-stake generally is more scalable, but it's much less decentralized than a proof-of-work system. And also the incentive structure is set up differently in a proof-of-stake system. There are now hundreds of different consensus mechanisms or consensus algorithms that different cryptocurrencies use, but the only one that is really truly decentralized is proof-of-work, or, you know, a very close cousin or derivative of proof-of-work. And I will get into proof-of-stake later on why the incentive structure of proof-of-stake makes it more centralized and means that it will trend towards centralization. So when we talk about the trilemma and we talk about these three different properties, again, we are really referring to the 6 properties that we want money to have. So uniformity, acceptability, limited supply, durability, portability, and divisibility. So when we talk about decentralization, what we really mean here is acceptability, so aka censorship resistant or permissionless, a completely decentralized system. Anyone will be able to trade and no one will be able to stop you from trading. Whereas a centralized system will be vulnerable to censorship, aka it will not be a permissionless system. And also, decentralization ensures limited supply because a centralized system is occasionally incentivized to increase the supply. And so when we talk about security, what we really mean by that is acceptability, limited supply. So if a protocol is 51% attacked, then double spend issues can actually increase the supply, at least for a short amount of time. And also durability. An insecure system will not be able to survive in the long run, and therefore will not be durable and will not look the same in the long run. And when we talk about scalability, what we really mean by that is divisibility, which essentially all cryptocurrencies have, but then portability. And it's quite a weird concept to think about Bitcoin in terms of portability or crypto in terms of portability. But what we really mean by portability is how much energy and how much money does it cost to send the bearer asset from one side of the world to the other, and also how much time does it take. So for example, Bitcoin is obviously a lot more portable than gold is. If you want to transport gold from England to Australia, for example, it's going to cost a lot of money. It would be hard to put a figure on it, and it would also take, weeks and weeks and weeks. Whereas you can send Bitcoin from the UK to Australia for much cheaper and much faster than you can with gold, at least cheaper for now. Whereas something like Kaspa, which only costs a fraction of a cent and will confirm within 10 to 20 seconds, that is more portable than Bitcoin is. So we'll get into some examples of when security has been compromised and the consequences that has had. So an extreme example of this is Terra Luna. They basically had a security exploit within their protocol, which essentially allowed for an arbitrage situation of a stable coin and the Terra Luna Classic token itself, which absolutely plummeted the price, as you can see here. So that obviously is an extreme example of what happens when there is a security flaw within a protocol. A slightly less extreme example was in Bitcoin Gold in 2018, when it was hit by a 51% attack, and the attackers were able to double spend, aka steal $18 million worth of Bitcoin Gold. So there are very real world consequences if a project does not have adequate security. In terms of scalability, so we're going to look at Bitcoin for this one. So Bitcoin is not scalable, as we know. This was especially relevant after the halving, when transaction fees rose as high as $250. They have since settled down, but it goes to show that if Bitcoin really does gain that huge amount of adoption, then transaction fees will be astronomical on the base layer. And those transaction fees on the base layer will actually prevent adoption from happening within Bitcoin. And if adoption doesn't come, then price doesn't go up. And, price going up is one of the main drivers on whether a cryptocurrency project is adopted or not. And so it's kind of like a spiral where if less adoption happens, then price goes up less, which means even less adoption happens, which means price goes up less. And so what we really mean when we say Bitcoin is not scalable is it's fundamentally not portable. It both takes longer and is more expensive to send it to another wallet address than it is something like Kaspa. And so what is the solution to the portability issue of Bitcoin? Well, one proposed solution is something called the Lightning Network. The Lightning Network is a layer 2, which essentially means that it would be a channel on top of the base chain. So there are two real problems with the Lightning Network in terms of 1 megabyte blocks still cannot onboard billions of people because you require on-chain transactions to open a Lightning channel. But to be honest, I don't see that as being the main issue. The main issue, in my opinion, is that Lightning channels are custodial systems. AKA, when you send your Bitcoin to a Lightning channel, you require a third party to hold your funds. And there can basically be two models under this. You can either have decentralized unknown third parties, but if then they are decentralized and unknown and potentially anonymous, then they are almost incentivized to run off with customer funds. And so if we do move to a model like that with small unknown custodians, then people will have their funds stolen within Lightning channels. And so really the only solution to that would be to have known large third parties which are trusted, but then they will also be subject to government regulation and control. So you therefore lose your permissionless network and lose the permissionless system of the network. And really, when you think about this, what you're doing is you're giving your collateral, the base asset, to a trusted custodian in order to increase the scalability and reduce the frictions that Bitcoin has. How is this really any different to gold and to the issues that gold had? The Lightning Network is essentially a fancy way of doing banking. And so logically, the Lightning Network will have the same structural issues that banking has. A, it will no longer be permissionless because it is now regulated and controlled by the government. And B, more than likely what will happen is that these custodians, because they have to pay the Lightning fees to open the channel and pay the fees for the base layer, they will say, okay, well, most people are not going to want their Bitcoin back all at once. So we can actually potentially create more claims on the Bitcoin than actually exist in the exact same way that banking works, which will then lead to a sort of Lightning Network banking runs. So ironically, Bitcoin layer 2s will fail for the same reason that gold failed, because of the lack of portability and therefore the need to use a centralized, trusted custodian to hold your Bitcoin and make it more scalable and more portable. And so there are very real world consequences that will come from the lack of scalability, or aka the lack of portability that Bitcoin has. And then we move on to decentralization. And when I'm talking about decentralization, I'm basically talking about any consensus mechanism that is not proof of work or a close relative of proof of work. And one of the main issues with a non-decentralized structure like this, like proof of work, is the incentive structure. So one of the main arguments that you'll hear about why proof of stake is good is that because the validators are large holders of a particular token, they are incentivized to be honest and allow honest transactions and not inflate the network and not grow the supply of the network, because they are holders of the network and therefore are incentivized to keep the network healthy and strong and trusted. But this argument immediately breaks down, because who is the biggest benefactor from the US dollar being the world reserve currency? Easily, it is the US government, and as a byproduct of that, the US population. So they have the biggest incentive to keep the US dollar strong and keep it adopted and keep it as the world reserve currency, and yet they are still driving the dollar essentially to extinction. Because if you have access to the ledger and have access to the rules of the ledger, then you are incentivized as someone in power to use the ledger to solve problems if you think it is the right thing to do or think it will help. And the Federal Reserve and the US government, even though they're building up all this debt, I don't think they're doing it evilly. They think they are doing the right thing. And in many ways, they are, bailing out the banks and creating a huge amount of stimulus in 2008. While it has led to all these unintended consequences, it was potentially better than the alternative. But the only reason we had that problem in the first place was essentially because of the portability issue of gold. A system will always trend towards more centralization. That is essentially the entire history of banking, that you have a relatively decentralized system, and then in order to increase the efficiency and lubricate the frictions of that system, you will increase the amount of centralization. But then a centralized system is a trust-based system, and a centralized system will essentially always be manipulated and always be used by the people in power. And so because these proof-of-stake systems are inherently centralized, even if they are, relatively decentralized for now, over time they will become more and more centralized, and more power will trend towards a few different validators. And those validators inevitably will have a huge amount of power within the environment and within the country. And so it is almost inevitable that they will use that ledger to try and solve problems, but at the expense of the people holding the ledger or holding the token. So having the lack of one of these characteristics of scalability or decentralization or security leads to very, very real world problems, as we have seen, and will lead to more and more problems down the line. As these networks grow and gain more adoption, the problems that they have will become more and more apparent. Kaspa, because it has solved the trilemma and it maintains all three properties of the trilemma, also perfects money and perfects what we want money to do. So it is divisible, it is portable, it is durable, it has a limited supply, it is acceptable or permissionless, and it is uniform. It perfectly fulfills all of the properties that we want money to have. And so over time, as the network gains more and more adoption, it will continue to function with the properties that we want money to have. And it will not be susceptible to these systemic issues that an inherent lack of portability or lack of decentralization or security or scalability has. And that is why I believe Kaspa is the perfect form of money and is really the only true contender to become the future money of humanity and the current financial system. And that is why I am unbelievably bullish on the future of Kaspa, because it is the perfect form of money and it is the superior monetary technology. So thank you guys very much for listening. That's everything I wanted to get into today. Again, don't forget to like and subscribe, and also check out the Patreon if you are interested in that. But other than that, thank you for watching, and until next time, cheers.